Most clients I talk to care deeply about the success of their wealth building strategies. Here are 3 important lessons about investing brought to you by Doug Oosterhart, founder of LifePoint Planning. Number 1, it's extremely hard for anyone to beat the market consistently. Whether you spend time looking at charts, balance sheets, crunching numbers in a calculator, getting tips from colleagues or so-called gurus, or even throwing darts at a dartboard, there's no evidence to suggest that people can consistently beat the market over time. One reason for this is that information is already priced in. With hundreds of analysts sometimes covering the exact same stock, it's hard to outperform the market based on information that you can find. A second reason that makes it hard for people to consistently beat the market is that building wealth doesn't happen overnight. People out there consistently will try to sell books or programs on how to get rich, and the most successful investors that I've ever seen only get rich and build wealth over a long period of years. So what should investors do knowing that they cannot beat the market long term? The first thing is have a plan. Something that you can basically build an investment portfolio around, knowing that it's in line with meeting all your goals. The second thing is make sure that the funds that you hold do not have high fees or high commissions to the advisor. The third thing is hold a diversified portfolio that's globally diversified so that not one investment in there will harm the overall success of building wealth. The second lesson is that investor behavior is actually the biggest reason for underperformance. A lot of people have heard buy low, sell high, but investors actually have a big problem doing that. The 20-year index return is actually quite a bit higher than what the investor gets that invests in that same index. A couple of reasons for this are that they buy last year's top performers first. They look at a stock and say, oh, or they look at a fund and say, oh, last year it returned the highest in its class, let's buy that. The problem is it might have already captured the return, and so you're not buying low and selling high, you're actually doing the opposite. Another reason for this is that investors tend to get their emotions involved when making investment decisions. Oftentimes this hurts investors because they, again, do the opposite and buy high and sell low instead of buying low and selling high. The worst thing that you can do is sell after the market goes down, because then you've locked in a loss. A lot of people think that, that is what they should do, when in fact the reverse is true. So how can investors practice behavior that doesn't hurt returns? The first thing that they can do is stick with their financial blueprint and their plan that details and outlines their steps for success. The next thing is that you do not want to sell and go to cash, because that actually lowers the success rate of the plan. The third thing is to have a plan for a down market, something that dictates that you do not have to sell out of assets that are down, and that you can actually maybe have a couple years worth of income saved in cash so that you can utilize that when the market does in fact go down. The third lesson is that fewer trades leads to more success. I'm sure people have seen CNBC, Fox Business, or Bloomberg talk about how to adjust their portfolios on a daily basis based on day-to-day market volatility. This is actually not good advice because it leads to lower returns long term and really harms investors' chances of building wealth. What investors should do is actually look at their portfolio only a couple times a year and decide if that's time to make any changes, but only make those changes if their plan or their long-term goals have changed. If their goals have not changed, then there's really no sense in trying to make short-term trades to try to cash in on something that's unpredictable. If you think it might be time to create or reevaluate your plan or current investment portfolio, then feel free to send us an email, give us a call, or check out our website. We will provide a free consultation to new clients that really takes a look at their comprehensive and overall strategies in order to build wealth and meet their goals. Thank you.